As you see, farm equipment maker Deere saw their shares down more than 4% today after the company's latest earnings. The company's results were better than expected, but its view for next year had investors concerned. Dominic Chu looks into why the investors were saying, oh dear.
It was a solid earnings report for Deere. The world's biggest maker of farm and agricultural equipment beat analyst estimates for both profits and revenues this past quarter. But it's the outlook for 2020 that had investors feeling less rosy. Trade tensions and bad weather, that combination has taken a toll on sentiment among some of Deere's biggest customers, American farmers. CEO John May said, quote, lingering trade tensions coupled with a year of difficult growing and harvesting conditions have caused many farmers to become cautious about making major investments in new equipment. Now, as a result, Deere now says it expects profits of between $2.7 billion and $3.1 billion in the year 2020. The high end of that range would still put the company's profits below what it made in 2019 and below what analysts were forecasting. The more conservative forecast comes as Deere prepares itself for sales declines in key product areas. Worldwide sales of agriculture and turf equipment are expected to fall between 5 and 10%, and construction and forestry equipment sales are expected to fall between 10 to 15%. While the story does sound downbeat for Deere, it could change relatively quickly and forcefully depending on how trade policies develop, not just on the U.S.-China front, but also the progress of the U.S.-Mexico-Canada trade agreement, or USMCA. Deere says that over the longer term, business will be good. A pickup in economic growth, not just in the U.S., but abroad as well, could shift sentiment more positively in the coming months and years. For Nightly Business Report, I'm Dominic Chu.